Hello everyone, my name is Joseph-Antoine Migdalani. Today I am with Karim Zakir, our portfolio manager, and welcome to our quarterly web capsule. Before we start, we just want to apologize quickly because our video is going to be delayed a little bit this time. We were usually posting this video beginning of October, but Karim was in a conference outside of Canada with some economists and other people from the industry, and you came up with a couple of good points that you shared with me. And let's start with the first one concerning the health and care.
Right. So hello everyone. So this was a very interesting conference where we had two speakers that were very interesting.
Mm-hmm.
The first one has nothing to do with finance. It has to do with your health.
Yeah.
And it was this health coach that came on, and this health coach described pretty much what everybody goes through in life. We have two accounts, everybody. We have the health account and you have your wealth account. Everybody starts with a health account that's full,
Yeah.
meaning you're healthy, okay? When you're young, you're starting off your life. And your wealth account, when you're starting off, is empty most of the time for most people,
yeah.
right? What happens through life is we get into our career, some of us become workaholics, we devote our life to our career, we have a family, we raise the children, and what happens over time is your wealth account tends to go up while your health account starts to diminish. And so we end up in a situation where we reach the age of 65 or 70, and you've reached your goals financially, but your health-wise, it's in the tank.
Mm-hmm.
You're not doing very well because you spent all that effort, all that stress. So the goal here would be to have a balance in life,
Yeah.
okay? And it kind of hit me because I've seen a lot of people come to retire, then they live 10 or 15 years of illnesses during their retirement. I mean, what's the use of having a happy retirement if you're going to be sick all the time? Yeah. So she gave us all a challenge in the hall, and many people couldn't do it. And she asked us to stand up and to try and stand on one leg for 1 minute.
Yeah.
Okay, and I give this challenge to all of you. Try and stand on one leg for 1 minute. If you can do that, you're in fairly good shape. Try both legs. The goal would be to stand up on each leg for 2 minutes. That's the ultimate goal. Another challenge.
Were you able to?
I was not able to, believe it or not. Now I am, because I've been practicing for about a month. But at first I couldn't do it. I couldn't last more than 20 seconds, you know. Mind you, I'm flat-footed, so it's a little different. On the other hand, she also gave us another challenge, was to be able to get to the floor, lie on the floor, and try and get up without using both your hands. Either hand, no hands. Try and get up. So if you could do that, odds are by the time you reach the age of 65, you'll have good mobility, which means that you'll probably be healthy and you'll have a healthy retirement. So something to consider.
Absolutely. And talking about our portfolio,
Yeah.
for our clients, good news is that probably the wealth account went up, right?
That's precisely the case. So far this year, the wealth account has risen, meaning the portfolios are going up. We hope it's going to continue into the end of the year. I think it will.
Yeah.
There's going to be volatility. It's normal. It's never a straight line. But I do see a good end of 2025. And on top of that, don't forget we had a good 2023 and 2024. That will make 3 consecutive positive, strong years for all the portfolios in general. 2022 was not a good year, but the last 3 years were made up for 2022
very good.
By a long shot.
And where do you think we're heading for the next few months or year?
Yeah, so they brought a second speaker at the conference who was an economist at one of the major big banks in Europe. And what I do is we take all that information from many economists, from strategists, from stock analysts, bond analysts, put it all together, and try to come to a conclusion on how to position the portfolios going forward.
Right.
And so I think we're at an inflection point. I think we're entering a period that's similar to the 1930s and similar to the 1970s. What happened that's in the 1970s, because more people have lived through that period in the 1930s. Between 1968 and 1980, the markets haven't done very well. They did nothing during a 12-year period. What has done well during that same period are commodities. Why is that? Well, the situation back then is very similar to the situation that we're starting to encounter today. Governments are spending a lot of money to get the economy going. When you spend a lot of money, means you have to print a lot of money. When you print a lot of money, you devalue the currency. When you devalue the currency, it becomes inflationary. When it becomes inflationary, what happens? Interest rates start to go up. So to be able to hedge oneself from inflation, you have to start considering owning real assets. And we're talking precious metals, we're talking critical minerals, we're talking commodities in general. A lot of people don't like commodities because they're cyclical, but they are a hedge to inflation. And so I believe that the portfolios that we're looking at, we're going to be considering potentially some changes going forward. You want to be exposed to financials, because I expect the midterm interest rates, meaning 1 to 6 years, to either stay flat or drop a little bit, not very much. But what's going to happen is the long rate is going to go up probably quite a bit. And when that happens, the yield curve on the bond market steepens. Now, this makes banks more profitable and makes life insurance companies more profitable, and property casualty insurance companies, because what simple math, what they do is they give you nothing in your checking account, like 0.01, yet they take that money and they lend it at a higher rate, the long-term rate.
Exactly,
so it makes it very profitable for the financial sector. Another sector that we need to maintain a position on, where there's definite growth, and I think we're at the beginning stages still, is the artificial intelligence sector. A lot of businesses, a lot of corporations are integrating artificial intelligence into their companies. We're starting to see layoffs from software companies. You wonder why are software companies laying off? I mean, it's a growth industry. Well, because a lot of the work can be done by artificial intelligence, which means that the businesses, the companies, the shares are going to gain in value because of efficiencies. It's unfortunate for people who may be subject to losing their jobs. They're going to have to readjust, but I don't think it's going to be drastic from the job loss side. And of course, we have to maintain defense, meaning companies like pharma, healthcare, in order to diversify the portfolio accordingly. So these are the positions we're going to be looking at going into the next 3 to 6 months. Going to look at maybe doing some changes in order to benefit from this inflection point that's going to start transpiring with time.
Thank you so much, Karim. Very well explained. And I always finish the quarterly web capsule by saying that we are here to assist you for financial planning, estate planning, tax planning, talk about insurance as well. So if you have any question, it's part of our offer, so it's completely free. Just reach out and we're going to be more than happy to book a meeting with you. And thank you so much for watching the video, and talk to you next time.
Thank you.